Recently, we have seen some complacency from investors on the markets, and we can see this with the lack of volatility in equities, both in Europe and in the US.
So Daniel, starting off, we have seen an unusual pattern in 2017 where we've seen European equities actually outperform US equities, and European stocks have outperformed US stocks 3 times. So what's been driving this?
So over the past few years, we have usually seen Europe lagging the US, both in terms of performance, but also in terms of its positioning in the economic cycle. Actually, the US are much further in the economic cycle than Europe. And actually today, the US economy is not improving anymore, where it seems like the European economic recovery has some room to go. Recently, macroeconomic data was much stronger in Europe, while we have seen a deterioration in economic numbers in the USA. Whether it's temporary or not is another question, but what is clear is that the US are much further in the economic cycle. As a consequence, the Fed had already more than 1 year ago started to normalize its monetary policy, while in Europe there is still no sign of tightening in 2017. The ECB should remain very accommodative, which should continue to be supportive for European assets. Another reason may be clearly linked to the political landscape. We have seen an improvement recently in the political situation in Europe, especially after the favorable outcome of the French election. While in the US, the erratic behavior of the President Trump is increasingly seen as a major risk for the US. And last, valuation. It's not unusual, but Europe is still trading as with a quite large discount relative to the US. And to see some more potential for US equities, we would really need to see an improvement in the underlying trends in earnings for US companies, which is clearly not the case today.
So despite this flat US market that we have spoken about, US Q1 earnings season was actually the highest in 2 years. So how heavily or lightly should investors view data coming out of the US at present?
Yes, the last earnings season in the US was very strong, actually the strongest one in 2 years. We have seen a majority of US companies able to beat analyst estimates, both on revenues, but also on earnings. Despite these great results, we have continued to see a downward revision trends in analyst estimates for 2017 in the US because these results were widely anticipated. In Europe, it's completely the opposite. Early 2017, analysts and market participants were really skeptical and cautious on Europe and on Europe growth prospects. And realizing the outlook was much stronger than expected, analysts had to drastically revise up their estimates for this year. And as a result, we should end up with a much stronger earnings growth from European companies this year than in the US. And this is mainly the main reason for the outperformance and the market catch-up of European stocks.
So Daniel, you are speaking on behalf of REYL Bank today, and they do see limited potential for US equities throughout the rest of 2017. So looking ahead for investors, what advice can you give them to protect their portfolios and to protect from future divergence in the markets?
Recently, we have seen some complacency from investors on the markets, and we can see this with the lack of volatility in equities, both in Europe and in the US. For example, the VIX index, which tracks the volatility of US stocks, has recently reached a 24-year low. So it's not a timing indicator. It does not mean that because it has reached record low, US equities will collapse anytime soon. However, along with other indicators like a stretch valuation for equities in the US, it's clearly a warning signal for investors in the short term. This year, most portfolio managers can show very decent performance, and we have not even reached the end of the first half of the year. And when the volatility volatility is so low, it means that protecting your performance is actually quite cheap. You can do so with multiple very easy vehicles. You can either buy put option on equity indices, you can buy call options on the VIX index itself, or you can design structured products that can benefit from consolidation in equities. So for a very small portion of your performance that you give up buying this protection, you can actually protect in a very effective way and a cheap way your performance, especially entering the summer, which is typically not very supportive time for equities.
Well, Daniel, once again, thank you so much for coming in today and sharing your insights with us.
Thank you.
That's all from us here in the Geneva studios, but we want to hear how you found this interview, so please do like and comment on dukascopy.tv.